There is a good chance you have been making your investing decisions based on a distinction that does not actually exist in the way most people think it does. If you have spent any time trying to figure out where to put your money, you have almost certainly run into this exact moment of confusion. You are looking at two things that seem nearly identical. Both track the same index. Both hold the same stocks. Both have similarly low fees. But one is called an ETF, and one is called an index fund. And somewhere along the way, someone told you they are different and that one of them is better. So you opened 3 browser tabs, read 4 contradictory articles, and ended up more confused than when you started. That confusion is not your fault. The financial industry has a remarkable talent for making simple things sound complicated. And this particular topic gets muddied constantly because the people explaining it often have a product to sell you. The honest version of this comparison is a lot simpler than the internet makes it look. And by the end of this, you will know exactly which one makes sense for your situation. Let's start with what these things actually are, in plain language. An index fund is a type of investment fund that tracks a market index. The most common example is the S&P 500, which is just a list of 500 large American companies. When you buy an S&P 500 index fund, you are essentially buying a tiny slice of all 500 of those companies at once. The fund automatically adjusts as companies enter and leave the index. You do not need to pick stocks. You do not need to time the market. You just own a piece of the whole thing. An ETF, which stands for Exchange Traded Fund, does the exact same thing. Most ETFs also track an index. Most of them hold the same underlying stocks as the comparable index fund. The fees are similarly low. The performance over time is nearly identical. So what is actually different between them? 2 things: how they are bought and sold, and the minimum amount required to get started. An index fund is priced once per day after the market closes. When you put in an order to buy, you get whatever price the fund calculates at the end of that trading session. You do not know the exact price when you click buy. You also typically need a minimum investment to get started, which varies by provider. Vanguard, Fidelity, and Schwab all handle this differently. Some require $1,000 minimum. Some have dropped minimums entirely. An ETF trades on the stock market like an individual stock. It has a price that changes throughout the day. You can buy or sell it at any moment during market hours, and you can start with as little as the price of a single share. At some brokerages, you can even buy fractional shares, meaning you could invest as little as $1 if you wanted to. That is genuinely the core of the difference. One trades continuously, one prices once a day. For the average long-term investor building wealth over decades, this distinction matters far less than the financial media suggests. Here is where it gets practical. If you are just starting out with a small amount of money, ETFs often have the edge simply because of accessibility. If you only have $50 or $100 to invest right now, an ETF lets you get started immediately with whatever you have. You buy a share or a fraction of a share, and you are in the market that same day. Some index funds would turn you away at that amount, or require you to wait until you have accumulated a minimum balance. On the other hand, if you are investing through an employer retirement plan like a 401k, you almost certainly do not have a choice. Those plans typically offer mutual funds and index funds, not ETFs. In that context, the ETF versus index fund debate is irrelevant because you are working with what your plan provides. If you are investing in a taxable brokerage account and you care about tax efficiency, ETFs have a structural advantage worth understanding. Because of the way ETFs are built and how shares are created and redeemed, they tend to generate fewer taxable events inside the fund itself. Index funds occasionally have to sell holdings to meet investor redemptions, and those sales can create capital gains distributions that get passed along to every investor in the fund, even if you personally did nothing. ETFs handle redemptions differently, in a way that typically avoids this problem. For a long-term investor in a taxable account, this can add up to a meaningful difference over many years. But here is the thing that trips up a lot of beginners. The index is what matters most, not the wrapper. An S&P 500 ETF and an S&P 500 index fund tracking the same index will perform almost identically over any long time horizon. The difference in returns between the two structures is tiny compared to the difference between choosing a good index and a bad one, or between investing consistently and not investing at all. The most important number to look at in either case is the expense ratio. This is the annual fee the fund charges, expressed as a percentage of your investment. A fund with a 0.03% expense ratio costs you $3 per year for every $10,000 invested. A fund with a 1% expense ratio costs you $100 for the same amount. That gap compounds over decades into an enormous difference in your final balance. A beginner who picks the right index with a low expense ratio inside either structure will do far better than someone who agonizes over ETF versus index fund while paying fees 10 times higher. Vanguard, Fidelity, and Schwab all offer both ETFs and index funds tracking major indices at expense ratios so low they are nearly zero. The specific numbers change, but the principle holds. You are looking for something in the range of 0.03 to 0.20% for a broad market fund. Anything significantly above that, and you are leaving money on the table for no good reason. Now here is the part that surprises most people when they first hear it. Some of the most popular ETFs and index funds are run by the same company, track the same index, hold the same stocks, and have the same expense ratio. The Vanguard S&P 500 ETF and the Vanguard 500 Index Fund Admiral shares are functionally the same investment in two different containers. Choosing between them is less like choosing between two different investments and more like choosing whether to drink water from a glass or a bottle. The water is the same. What actually matters for your long-term outcome is not which container you pick. It is whether you start, whether you stay consistent, whether you keep your fees low, and whether you resist the urge to panic sell every time the market drops. Those four behaviors will do more for your financial future than any technical distinction between fund structures. Pick the one that removes friction from your life. If ETFs let you start today with what you have, start today. If your 401k only offers index funds, use the index fund with the lowest expense ratio available. If your brokerage makes it equally easy to do either, flip a coin and then forget about it for 20 years. The investor who starts with an imperfect choice and stays consistent will always beat the investor who waited for the perfect answer and never began.